Hello and welcome to our Q4 2011 Global Capital Flows presentation. My name is David Green-Morgan, Global Capital Markets Research Director at Jones Lang LaSalle, and today I will be presenting the results of our Q4 research, looking back at 2011 and forward to 2012. A note at the outset that all the figures quoted in this presentation are in US dollars. 2011 finished with a bang, and it was the upside in the European markets that was most surprising. In the fourth quarter, there was $106 billion worth of investment into direct commercial real estate globally, which was up 4% on the third quarter. The strong end to the year made the fourth quarter the most active of 2011, just beating Q2 and making Q4 2011 the second most active since the financial crisis. All of the regions saw increases in Q4, but it was the surge in Europe, up by 8%, that was most surprising, given investor sentiment in the region at present. Full-year volumes were even more impressive, with a 28% increase on 2010 to $411 billion. Global volumes are now back above the levels we recorded in 2008, and well above the lows of 2009. The Americas were the star performers in 2011, with a 60% increase. EMEA came in 20% above the previous year, while Asia Pacific finished 6% higher. Given the natural disasters that befell two of Asia Pacic's largest markets, Japan and Australia, in the first half of 2011, together with a tighter monetary policy in China, a fall on the previous year's results was expected. The quarter-on-quarter and year-on-year results are demonstrating an interesting trend, that of investors pursuing opportunities in the USA and Europe, which are forecast to have lower economic growth than Asia Pacific. During the year, we have seen a surge in capital targeting the Americas and Europe. Much of this capital is coming from Asia Pacific and global funds that raise their money worldwide. In Q4 and for the whole year, the USA retained its status as the #1 source of real estate investment capital, with over $25 billion worth of purchases in the final quarter and over $100 billion for 2011. Global funds are the next closest, with just over $50 billion worth of purchasing activity. Demonstrating the active nature of the European market this year, Germany and the UK both registered over $25 billion, while Japan remains Asia Pacific's most active investor with $18.5 billion. As we have mentioned, there has been a movement of capital into Europe and the US from Asia Pacific in particular. Investors from APAC are increasingly looking outside of their own region for real estate investment opportunities. One of the countries to contradict this trend is Australia. The Australians have been big net sellers of property over the last 2 years, to the tune of $13 billion. European groups who have been net sellers are the British, Irish, Danes, and the Dutch. But who has been taking advantage of these buying opportunities? Well, predominantly it is investors from Asia, with the Singaporeans, Malaysians, South Koreans, and investors from Hong Kong buying. Only the Canadians are able to break the APAC stronghold on cross-border investment. Global funds, by their very nature, invest 100% of their capital across borders. Developers and property companies, both listed and unlisted, are hurting the most at the moment. On the back of strong net selling in Q3, $12 billion, they continued in Q4 with a further $14.5 billion of net assets sold. Their full-year divestment was over $40 billion, following a net sell-off to the tune of $31 billion in 2010. Who is taking advantage of this selling? Unlisted funds, institutions, and REITs have been strong net buyers in 2011, and they continued this trend in the final quarter of the year. After significant problems during the financial crisis, listed and unlisted funds seem to be back on track, although longer-term investors may have seen their holdings diluted by capital raisings. With spare cash on the balance sheet, these funds look now to be taking advantage of weakness in other parts of the property market. The retail sector in Europe and the Americas recorded significant increases on 2010 transactional levels, up over 40% in Europe and 96% in the Americas. In both regions, volumes are now approaching those at the top of the market in 2007. This at a time when retailers on both sides of the Atlantic are suffering from anemic growth in retail sales and a rise in internet shopping. Retail illustrates the point perfectly that investors are returning to core developed markets at the expense of new emerging countries, even when growth projections are weak in these developed markets. On a quarterly basis and for the full year, London has emerged as the most active city globally, just beating a surge in activity in Paris in the final quarter. On a full year basis, New York has reclaimed second spot from Tokyo. Asia Pacific now has 5 of the top 10 most active cities globally. The emergence of new cities into the global investment market is discussed further in our research paper, A New World of Cities Redefining the Real Estate Investment Map, which can be found on the Global Capital Flows website. So that wraps up the analysis for 2011. What do we expect in 2012? The strength of transaction activity in the final quarter of 2011 surprised many market participants. Investor sentiment is probably at its weakest since the global financial crisis, and no week seems to pass without an organization downgrading their economic forecasts. Commercial property faces a balance of positive and negative drivers. Yields look attractive when compared to government bonds, and real estate provides the attraction of a fixed asset with a potential of rental growth in years to come. On the downside, the lack of new debt for commercial property will continue for the foreseeable future, and CMBS markets are only gradually recovering. However, the level of activity we are seeing from underbidders on the best quality assets in particular demonstrates that the level of equity available remains high. While we don't believe 2012 is going to set any records, if the current economic environment of slow but steady progress with the occasional roadblock continues, then we forecast that investment volumes will match those of 2011 at around $400 billion. Downside risks are evident to all, and any negative change in the Eurozone debt situation could have a significant downside impact on investment activity. Well, that's all from me, and I look forward to bringing you the Jones Lang LaSalle Global Capital Flows update next quarter.